Here's what you need to know about Alibaba's antitrust investigation and how it impacts Alibaba's stock and its investors. On December 24, 2020, China's State Administration for Market Regulation, or SAMR, launched an antitrust probe on Alibaba, China's largest e-commerce company. As a result, Alibaba's stock fell over 13%, its largest one-day drop on record, and lost over $80 billion in market value. Investors should understand the details of China's antitrust regulation and the risks associated before investing in Alibaba. Let's start by discussing the anti-monopoly investigation. The investigation plans to look into monopolistic behavior from Alibaba, with emphasis on the choose one of two business practice. This practice involves merchants having to exclusively sell on one e-commerce platform. If merchants choose to sell on a competitor's platform, they run the risk of having their products ranked lower in search results, decreasing consumer traffic to their store, among other consequences. What's important to understand is that the choose one of two practice is not a new issue, and antitrust regulators already plan to launch an investigation into it. Going back to 2015, JD.com, the second largest e-commerce company in China by market share, filed a complaint to regulators stating that Alibaba had forced sellers to choose between Tmall, Alibaba's B2C platform, and other platforms. In 2017, JD.com sued Alibaba over the alleged practice. According to the case, JD.com said Alibaba's Tmall had sought commitments from merchants to not open stores on JD.com's platform. JD said at the time that Alibaba had engaged in similar practices since 2013 and asked the court for 1 billion yuan, equivalent to $153 million in compensation. The case remains under trial, and in a 2017 earnings call with analysts, JD's CFO acknowledged the dispute, saying that more than 100 brands had withdrawn from JD's platform because of a certain competition's practice. Vipshop and Pinduoduo, two more e-commerce companies, have also filed applications for joining the case as a third-party member. Another major case regarding the choose one of two practice surfaced in 2019, where Galans, a home appliance manufacturer, sued Tmall after its online traffic decreased and its page seemed to disappear from Tmall search results following a trip by company officials to Pinduoduo. Following this, SAMR called more than 20 of China's major internet platforms to a meeting. During this meeting, officials emphasized that choosing one of two is a behavior violating China's e-commerce law, as well as the antitrust law and anti-unfair competition law. Authorities also announced that they would start antitrust investigations in the sector soon, without disclosing a specific timetable. Then, in November 2020, SAMR introduced antitrust draft guidelines that aimed at regulating China's internet platform companies, with one of its articles outlining the issue of platform exclusivity. How does this regulation impact Alibaba? China's anti-monopoly law allows for a maximum fine of 10% of a company's sales from the previous year. Taking a look at Alibaba's annual report, Alibaba reported around $72 billion in revenue. As a result, the maximum 10% fine would equal to about $7.2 billion. However, this would be a one-time fine and would not have a material impact on Alibaba's growth in the long term. What could have an impact on Alibaba's long-term growth, however, is Alibaba's competitive positioning in the e-commerce industry following this regulation. If Alibaba's alleged choose one of two practice is regulated, then Alibaba's advantages against its competitors could decrease as it loses exclusivity on its platform. On the contrary, its competitors look to benefit. JD.com and Pinduoduo, Alibaba's two largest e-commerce competitors, would likely benefit from the regulation of the choose one of two practice. Based on lawsuits involving the companies, the regulation of the practice would encourage sellers to list on more than one platform, likely leading to additional sellers joining JD and Pinduoduo. JD has been primarily competing with Alibaba in first and second tier cities, with Pinduoduo competing in lower tier cities. As a result, with the added benefit of more sellers, they could potentially take away additional market share from Alibaba on two fronts. Another beneficiary may be Tencent, who is a strategic investor in both JD and Pinduoduo, as well as a major competitor to Alibaba. However, what's important to note is that China's antitrust draft rules still apply to all of these companies, and they will face increased regulatory scrutiny moving forward, potentially offsetting these benefits. Despite these challenges, Alibaba's powerful network effects and scale will serve as a strong economic moat against its e-commerce competitors and this regulation. It also continues to benefit from major secular trends, such as China's rising middle class, increasing digitalization, and more. As a result, Alibaba's e-commerce business looks to sustain its double-digit revenue growth. In addition to its e-commerce business, Alibaba's cloud business is also experiencing high growth, retaining its number one market share in China, and plans to achieve profitability in 2021. These are only some of Alibaba's many long-term investment catalysts moving forward. In addition to the antitrust investigation, regulators have announced additional updates regarding Alibaba's 33% owned Ant Group, its financial technology business that originally planned to IPO in November 2020, but was cancelled days before listing. Officials have stated that they want Ant to return to its roots as a payment services company rather than having lending as its largest business. As of now, Ant's credit technology business, which provides credit to individuals and small businesses, generated 39.4% of Ant's total revenue in the first half of 2020, making it Ant's largest revenue stream. Ant currently funds 2% of its loans, with the rest primarily funded by banks. Ant charges a service fee on each transaction equal to around 2% of the value of the loan, which offsets the 2% of capital that Ant reportedly contributes. It keeps a substantial part of the interest payments, making the credit business segment highly profitable, with 48% of the company's earnings coming from the segment. However, regulators announced new guidelines that would require lenders such as Ant to fund and retain up to 30% of the loans they originate. As a result of this regulation, Ant's initial $310 billion valuation in its planned IPO could be significantly reduced for two main reasons. For the first reason, keeping 30% of the loans on its own books would reduce the profitability of Ant's credit tech business, since Ant currently puts up only 2% of capital. For the second reason, because of this new regulation, Ant's valuation may be priced closer to that of a financial institution over a tech company. Fintech companies trade at higher multiples than traditional finance companies, and if Ant is categorized closer to a traditional financial institution, its valuation could be dramatically reduced, since Ant currently presents itself as a tech company. For these two reasons, Ant's initial $310 billion valuation could decrease by up to 50%, depending on the extent of the regulation. In addition to regulation, two other risks that Alibaba face include potential delisting and its VIE structure. The Holding Foreign Companies Accountable Act raises a delisting risk of foreign companies from U.S. stock exchanges that do not comply with the Public Company Accounting Oversight Board within 3 years. However, due to the scale of U.S. investment into Alibaba through pension funds, mutual funds, and more, it would be a conflict of interest for the U.S. to delist Alibaba and potentially wipe out billions of dollars of U.S. shareholder value. Moreover, Alibaba has a dual listing structure, having listed in the HK Stock Exchange, which provides an alternative option to invest in Alibaba. The other risk that many investors have had concerns about ever since Alibaba's IPO is its VIE structure. When investors purchase shares of Alibaba's on the New York Stock Exchange under the ticker symbol BABA, they are not actually investing in Alibaba directly. Instead, investors are actually investing in a variable interest entity, or VIE. A VIE is a business structure built upon a series of contracts between an offshore company and an onshore operating company. In Alibaba's case, shareholders are investing in an offshore company that has contractual rights to Alibaba's profits. However, shareholders don't actually have any ownership of Alibaba itself. As a result, shareholder rights are limited, such as a lack of voting rights, posing numerous risks to investors. For investors who are willing to take on the delisting and VIE risks, there are a number of key points to talk about regarding Alibaba's stock. From a fundamental analysis standpoint, there is strong evidence that Alibaba's stock is trading at a discount to fair value. Alibaba's shares are trading slightly above its 2018 levels despite doubling its revenue since. From a relative valuation standpoint, Alibaba also appears to be undervalued, trading at a large discount to its e-commerce peers at an estimated 17 times forward price to earnings, despite revenue growth of 30% and adjusted EBITDA growth of 29%. Moreover, there haven't been any fundamental changes yet in Alibaba as a result of the antitrust probe. As a result, investors may argue that the initial sell-off has been overdone. Alibaba themselves may also think so, announcing an increase in its share buyback program from $6 to $10 billion. However, this amount is fairly small compared to Alibaba's $600 billion plus market cap and is unlikely to have a material impact. That being said, it's important to note that Alibaba has historically traded at a discount from a relative valuation standpoint, potentially due to its VIE structure and accounting concerns. Moreover, the increased uncertainty regarding government regulation on its core commerce businesses and likely impaired valuation of Ant Group may negatively impact Alibaba's share price in the short term, with sentiment outweighing fundamentals. Rather than only focusing on Alibaba, potential e-commerce beneficiaries from Alibaba's regulation, such as JD.com, could provide alternative investment opportunities. That being said, investors will have to make their own investment decisions based on their own research and personal risk tolerance. Subscribe to learn more about Alibaba and other companies in China, leave a like, and comment down below what you think about Alibaba.